Hello and welcome to the R3 Mortgages. Welcome to the R3 Mortgages Refurbishment Buy to Let. Today we are going to be talking about refurbishment buy to let, buying, improving, and keeping. It's today, the 5th of February 2020, and I hope everybody is on board and you can hear me loud and clear. This presentation is coming to you from our offices in London, so I hope that we are all ready to go. February is among us. We have already lost January. Where is this year going already? Let's see if we can make some money in 2020. Okay, before we kick off, as usual, especially from the last seminar, just want to go through and just highlight a few points before I go on to the topic of this evening's presentation. Just to let you know, the webinar is for general use only. We don't accept any liability for any errors or omissions, and please take advice from suitably qualified professionals before you embark on your own journey, and especially anything to do with legal or tax advice, you should be speaking to a specialist. Okay, so what we're going to be talking about today, and I'm going to try and keep this within 15 minutes. Last time we went over our time. We're going to be talking about buy-to-lets. We're going to be talking about and explaining what bridging is. And then we're going to be going on to the main point that I want to draw everyone's attention to, special hybrid products that have emerged for refurbishment buy-to-lets. And then we're going to be talking about how they can be used, looking at specific case study, and then we will end with some top tips, and I will enable the Q&A mode from there onwards. So let's get cracking. So let's talk about buy-to-let, and especially where we are at the moment. Buy-to-let purchases specifically have really dropped off over the last few years. And speaking to a lot of investors, that is really because a lot of them feel that the returns aren't there as they once were. You could buy something, hold it for a couple of years, refinance it, it's gone up great, there's been some capital appreciation there, pull out some equity, put it onto the next deal, keep on rolling and moving forward. And especially down here in London and the southeast, that has, made people, or some people, property millionaires over the last decade or so. But things have definitely changed, and a lot of people are struggling to recreate the success that they used to have. Also, with traditional buy-to-let models, what we've found is that with the changes in regulation, especially with portfolio landlords, a lot of the larger buy-to-let landlords, because of the more generous calculation, have now been fixing their deals for a 5-year period to generate the benefit from more attractive calculations that have been available to them, basically allowing them to borrow more. So again, previously the model of keeping something for a couple of years, then refinancing it, pulling out the equity to put towards that deal. People are now generally looking at more 5-year horizons, which obviously is limiting the moves that they can make on subsequent transactions. And also, has everyone recovered from just completing their tax return and having to pay the tax that's due? A lot of landlords, especially the high rate taxpayers, are still recovering from the changes that have come in force, and it's not going to, or I can't see it getting better anytime soon. So when you factor in all of these different points that are hitting landlords, it's not a criminal offence to be a landlord, but a lot of people feel that it is, from their point of view, from the ways that they're being knocked. And what's happening is that property investors, although people are still believing in property as a long-term vehicle, an asset for their wealth creation, a lot of them are looking at ways of maximizing their wealth and returns. So I'm going to go on to now just quickly explaining bridging finance and the concept of that and how that works. Because again, I think a lot of people may have some misconceptions about bridging finance and how that can be used successfully by property investors. Essentially, bridging finance is short-term financing. The key is in short term there for people who are looking for fast turn around on their transactions. So it's really where speed is of the essence. So you could be somebody who's saying that they'll offer you a property, but they want a transaction done within a certain period of time. It could be an auction purchase where you've got 28 days to complete. Ultimately, that's where bridging comes in to prop up the financing options available to you. With bridging, because speed is of the essence, some lenders use various methods. So rather than instructing a formal valuation on an asset, if it's a certain loan to value, they may be happy to do a desktop valuation, thus reducing the time needed to get the offer out to you as soon as possible. Historically, people have used bridging finance for things like when you're buying a property at auction and maybe it needs some refurbishment, or you're looking at breaking a chain, or again, the typical one is buying something at auction and you need the deal done within a certain period of time. Otherwise, there's going to be penalties, or you're getting the deal because you've agreed to do it within a certain period of time. With bridging finance, how it works from, let's say, a conventional term mortgage is that usually they're set up, and there's a range of bridging lenders in the market. There's normally a setup cost, a facility fee charged by the bridging lender, and then there's a monthly interest that is charged on the outstanding amount while it is owed. So hence the reason why it is short term, because to make use of it efficiently, you want to be in and out of it as quickly as possible. And the rates that the lender will charge you will depend upon their appetite, and also dependent upon the loan to value that you are borrowing against the value of the property as well. So with bridging, you normally get it because you've got the exit in mind, but you might need it because conventional finance is not open, or it's not available during the time that you need it to done with, or it could be a property that in its current state, lenders or getting a normal mortgage wouldn't lend on them. Now, with bridging finance, historically, whenever I've discussed it with people, a lot of people have raised the question of the cost. Well, if you've got to pay a couple of percent to arrange a loan, and then you're paying, let's say 0.6, 0.7%, whatever, 0.5% a month in terms of the monthly interest, that's ridiculously expensive compared to a normal mortgage where I might be paying 2, 3, 4%, whatever on the open market. Yes, it is, but the bridging there is therefore a stopgap in terms of helping people to get deals done. So that explains how traditional buy-to-lets work, and that explains how bridging works. So usually you would do a bridging loan and set that up separately with the company, and you would have then the exit or the knockout arranged with another lender who would be separate from the bridging company, and then ultimately you would take the term mortgage to knock out the bridging loan when the works had been done or when you had arranged the financing. However, there are now some lenders who have actually created a hybrid of the two models. So that is combining to some extent the benefits and the flexibility that bridging finance give you, along with your exit already lined up in terms of a term mortgage. And the advantage of these said products, one of the main advantages, is before you even enter in or conclude on the main transaction, you have already got your exit sorted out. The biggest problem that you'll hear with any bridges, and I can tell you a number of different stories, is where bridging loans have gone on and on and on, or they've taken bridging company with lending with company X, and they're trying to sort out stuff with company B. They're giving all the information again to company B that they needed when they did the bridging loan, or they're doing the legals with different people, and it gets complicated and it gets convoluted. With these suites of products, essentially the bridging and the term mortgage is offered by the same lender. Okay. Now, the advantages on there is if it is offered by the same lender, you have got the same underwriter or the same people at the lender's offices looking at the same transaction. They can see where the start point is and they can see where the end point is. And the main advantage being is that you've got that predetermined exit in mind. These are mainly useful for light refurbs or things that can be done within permitted developments. Anything classed as a heavy refurb, these specific suite of products may not be designed for it. So essentially, it's where you can get in, do some work, usually between 3 or 6 months, and then it can be ready to be taken out on the term product. So the advantage is that you do one application to the lender, you'll get one offer for the bridging element of it, and then one offer for the term mortgage. And again, you can use the same lawyers during the same process. So we can just walk through and tell you how it works. Whilst you are doing the works, and the works can be, you may want to buy property and convert it into a HMO, for example, which is the case study that I'm coming to in a moment. While you are doing the works, no payments may be necessary in the interim as the interest is being rolled up by the lender. Bridging, you can normally go up to about 75% loan to value, and on the exit, sometimes you can go up to 75, even 80% loan to value. So used effectively, this can be a very useful tool of buying a property, doing the work, getting it revalued at the higher amount, and then essentially pulling out the money that you have had in there previously. So where can it be useful? It can be useful in scenarios where you're changing a property to a standard residential property into a HMO, into a house of multiple occupancy. You could be changing or reconfiguring rooms within a property. You could be going in, and it could be something that in the current state won't get their best maximum rental potential. So you could be going there and doing refurb work, or if it doesn't meet the EPC requirements, you could be doing that. But essentially, it's where you're going into it, doing something to add value. Before I come to this case study at the moment, let me just go back to the other one. I just want to explain to you the process of how this would actually work. You would put an application into the lender with the property that you're looking at. You would also include with them a schedule of works that you're going to do on the property. So it could be, lender, I'm going to buy this house. It's currently set up as a residential property. I want to convert it to a 5 or 6 bedroom HMO. To do that, I need to do these works, and I'm going to provide you, Mr. Lender or Mrs. Lender, whatever, schedule of work. And this is how I'm going to do it, and this is exactly who's going to do the work and the costings involved. The lender will then send a valuer out to the property to appraise the property in its current state. And then the valuer, with the schedule of works that you've given them, will also give an indication of the value that it will be worth after you've done the said works on the property. If the lender's happy with that, they'll issue you with your 2 offers, one for the bridging and one for the term mortgage thereafter. You then complete the transaction on the bridging, and they would release you a certain amount of money for you to be able to purchase the property and for you to actually start doing the works that need to be done. Let's say after 3 months, or between 3 and 6 months, you've done the works that needed to be done. You've partitioned it into a HMO, put fire doors, whatever's needed to be done. Then basically what happens is you contact the lender, and they'll send the valuer back out to the property, and they'll ensure that the works that you've said you're going to do have been done. And then they will confirm to the lender, yes, we're happy that the works have been done. Now the property has now increased in value to X, and now the rental potential is Y. That will then be returned to the lender, who will then say, fine, we're happy to go ahead, inform the solicitors, and then the solicitors can then do the remaining legal work to ultimately redeem the bridging part of it, and then the mortgage will continue as a normal term mortgage. Okay, so just running through a quick case study where time is rapidly running away with us for a particular scenario. that I've come across. So 4-bedroom property purchased for 293,000. Send the valuer out in the standard form as it is. The rental potential is £1,200 a month. So down in our part of the world, that would equate to a 4.9, just under 5% yield. Okay. In this particular scenario, we wanted to take the property from a 4-bedroom standard residential property into a 6-bedroom HMO. But work's going to need to be done on the property, the kitchen, the bathrooms, partitioning, making it all compliant to the HMO standards, which is going to take about 3 months to do the work. The valuers valued the HMO once the works have been done after a period of 3 months at 340,000, which is the same figure that they gave the indication of previously, and the rental potential at 2,925 by amalgamating the rental income of all the rooms within the HMO. Therefore, returning the asset at a 10.3% yield from something that would have originally given us a 4.91% yield. Obviously, before the costs of work's done and all the cost of finances have been done, we've taken an asset that's worth 293,000 and improved it to 340,000 within a 3 or 4 month time horizon. Also, then what you can do is then, based on the uplifted value, which in this particular scenario is 340,000, the bank's offer is then at 75% of that amount, or it can potentially even go up to 80%, which means you can re-pull out quite a lot of the money that you use for the deposit, leaving some money in, and now you have got your deposit to go and to do the next transaction. So in this particular scenario, used well, it could actually go and be a good way of building a portfolio and doing it, adding value, adding appreciation onto the property and getting a very good yielding asset for, let's say, this part of the world. I appreciate the further north that you go, the yields are better for rental properties, but the capital appreciation may not be as great as down here into the southeast. Okay, so top tips before we come on to a Q&A session. Before you're going to embark on anything like this, you need to research, and research. You need to research the area. You need to know, if, for example, if you are converting the property into a HMO, is this an area where there is demand for HMO and there's demand for rooms? There's a number of websites that you can go onto to see exactly what the rooms are letting out in your particular area, or alternatively, you can speak to local agents who are involved in that space. But really, really research. And with a lot of these deals, like any property investor will tell you, a lot of the benefit and a lot of the profit comes from the amount that you pay for the asset in the first place. So you need to make sure you've got your schedule of works costed out really to the T, because if your costs run away from you and it eats up the profit of the transaction, it could cause you an issue from there onwards. Now, with regards to contingency, you want to make sure that you've got a contingency for the particular project that you are doing, and make sure that if there are any overruns, you're not going to be into any particular trouble. And then what you need to do is carry on the proposed works. If you have told the lender in your schedule of works you're going to be putting this kitchen in, or you're going to be doing this, or whatever, when they're coming back to re-inspect the property, don't show them something that you haven't done or to the standard that you said you were going to do in, because that could impact the valuation from there onwards. If there are any hitches or anything that comes up that causes you issues or anything like that, or you think that you're not going to be able to hit the time periods, you need to make sure that you keep your broker and lender ultimately informed, so you work with them, because as we can appreciate, things do overrun. There could be some issues, and the ultimate final thing is, if you're doing any type of refurbishment project that's involving any element of bridging, you really want to get the works done ASAP. So get the crew in there, get it all timed. Don't be sitting in there and the electrician can't be doing it because he's on the job for 2 weeks. Get it in, get it done, get it revalued, get the offer out on it, and if there is an increase in price, then happy days, you're left with an asset that's going to give you a much better yield. And also by combining the refurbishment buy-to-let, doing it within the hybrid product, you could be left in a situation where even your overall costs of doing the deal are more beneficial than if you had gone to, let's say, a bridging lender separately, or if you had gone to someone to take out the term deal separately as well. So do your research and make sure you know exactly what your exit is, when your exit is, and what the demand is for what you're doing in your local area. Speak to the professionals. Okay, you're on listen in mode there. I am now going to open it up for questions. If anyone has a question, you can tap it in and I'm happy to answer them for a few minutes in the time that we have left. Are there any questions? No, either everyone has, I've covered off everything, which I find very surprising, or alternately, okay, here we go. We've got a question. How do rates differ between the hybrid mortgages and the buy-to-let? So on the standard buy-to-let, on the exits, there are not a huge number of lenders in this market. So if you wanted to do the hybrid model, you're limited to the lenders that will do it. But I don't think you're massively disadvantaged, bearing in mind what I'm seeing at the moment. The other big thing, which I'm not may have failed to cover, is that you can also do this within the guise of a limited company as well. So if that's what you want to do, and obviously with the tax changes and speaking to your accountant, you want to do that, this can all be done within a limited company as well. You can even have up to 4 directors with some lenders doing it onto the transaction. So the rates differ mainly in terms of the element of the deal that's on when you're on the bridging side versus when you're on the term mortgage. A standard term mortgage will give you an interest rate, let's say hypothetically 3.5%. For a certain period of time, and then you just pay your monthly interest only amount there if you chose interest only, whereas the bridging amount would charge you a facility fee to set up the deal, and then it would the interest cost would actually work out for how long you are borrowing the money. That's why on these deals you want to get the works in and out and done as quickly as possible so the deal could be stuck on the term borrowing. Can you explain the mortgage revaluation on the example you gave? You mentioned that you can release money from the property. Sure, yeah. So if on the original transaction you had borrowed at 293,000 and rolled up with all the interest, the lender let you go up to 75% loan to value, they might have included 6 months interest there. And then later on you've got an asset that's worth 340,000 and then you're taking 75% of the borrowing there, or in some cases can go up to 80% of the borrowing there. What that means is the money that you originally put into the transaction for the bridging element, you can ultimately utilize that and pull it back out. So you could come away with the money that you put in originally, a proportion of it back out, dependent upon whatever it valued it out. And when they're working the end valuation, the 2 key figures that are going to always play in mind here. Number 1 is going to be the property valuation, because that's going to determine the loan to values. And secondly, is going to determine it is the rental income. Usually with HMOs, if you've got decent rental income, it would be more down to the loan to value that you'd need to play with. Is there any risk of being stuck on a bridge loan and not being able to exit to a buy-to-let? Very good question. Very good question. Essentially, if you keep within the parameters of the deal, the things that could go wrong are this. The valuer goes round and something detrimental has changed. So where they originally gave an indication, that's no longer the case. The works haven't been done to the required standard, or something goes wrong with regards to that. So technically, a lender in their terms will always cover themselves from that point of view. But if you keep to the timing, the key thing is if you don't keep to the timing, and let's say your onward buy-to-let offer has expired, then potentially, if the lender's criteria or their terms have changed, you may be subject to those. But there is that argument if you were to do it bridging separately anyway. How can I get the highest post-work valuation from a surveyor? You know, the real key to this question, the answer to this question is how much preparation you do and how much information that you actually give them. I've got clients who, when a surveyor comes round, if there have been any comparables on the market, they'll present them with those. Obviously, a surveyor is going to do their own independent research, but if there's any information that they can give them, they'll give them those. In terms of a schedule of works, you could fill in 4 or 5 lines and just say, replace this, blah, blah, blah. This is how much it's going to cost. The more work, time, effort, and energy, if you can get any pictures of any kitchens that you're going to be putting in, or if you're going to go for a certain level of quality, especially within your HMO, if you can provide that to the valuer when they come round, that's going to give them the most, I'd say it'd be most beneficial to them when they're coming to assess what the post-works valuation is going to be. In a lot of cases, they're also going to be driven by comparables. So if you are looking at HMOs, what other HMOs are currently on the market, what rooms are letting out, and also what appetite there is. Do not do, or be very wary of doing a HMO in a market that is not designed for HMOs, because A, you'll struggle to rent the property, and B, that will be reflected into the valuation. If there's situations where you're close to large city centres, where you've got student populations, things like that, that's where you want to look at it. If there are few comparables of HMOs in your area, that's where you may struggle with valuations. Okay, I think that's it. Unless there are any final questions, we will call it a day there. Thank you very much for your attendance. We're going to do these webinars as part of our Inform and Educate series. I'm going to aim to do them every other Wednesday at the same time. The next one is going to be on top tips when buying a property. There's a lot of movement going around in the property market at the moment, especially with the Boris bounce, so to speak. So just some hints and tips of, if you are thinking of buying a property, things to consider and to take into account. My name's Riz Malik. Are these webinars available to view at some point later? Yes, on our Facebook page, on our YouTube page, R3 Mortgages, and also on our website, r3mortgages.com. We're going to be putting all of this information on there, so if you want to watch it later on at your own leisure, then you can do. My name's Riz Malik from R3 Mortgages. Thank you very much for your time this evening, and I shall see you soon.